Did you know that actively managed funds might actually lose you money in the long run? Here's why paying high fees for a fund manager is a bad idea. If you have any questions about the topic we are going to cover or finances in general, feel free to just ask me in the comments. In the short before, we talked about the fact that nearly 100% of fund managers underperform their correctly chosen benchmark, supported by research from Gerd Kommer. It's like playing the lottery. Only investing into actively managed funds is even stupider, as in the long run none of the investors seem to win. Except of course the fund managers and associated institutions, as they will collect their fees no matter their performance. Of course they would also prefer to perform well, as that would increase their collected fees and bring in new customers. And surely most fund managers are very capable and hardworking. But at the end of the day, at least this is what our current understanding of the stock market heavily suggests, a single person or team does not hold a candle to the predictive power of the entire stock market system. This explains in part their bad underperformance. Additionally, fund managers, like every other profession, need to be paid. They are getting paid by the fees they charge on their funds. But here is the big catch. Compared to almost every other job there is, their work seems to not create any value at all. You could even argue their work is more harmful to their customers than useful. But compared to low-cost ETFs, the high fees cut into their performance every year. In the first year, the additional fees might only be 1 or 2%, but after 30 years with the power of compound interest, that can accumulate to a much bigger percentage. Even our value investing prodigy, Warren Buffett, recommends that most people invest into an ETF instead of stock picking. Source CNBC from 2020. But by the way,